One. Hey guys and gals, it's Logan Freeman and
Alex Olson.
the one, the only Alex Olson. We've got an interesting show for you guys today, and we're going to take down the 800-pound gorilla, which is the economy, inflation, and interest rates. And when I say we're going to take it down, we're going to break it down in relation to what I think people should be thinking about right now. One of the questions we keep getting on a regular basis is, where are asset prices going? And, how does that compare to inflation? We've got the stimulus. We have all of these different things happening. And what I'll say here is there's not just two sides of the coin. There's three. You've got heads, tails, and you've got the edge. You have to stay on the edge. And I'm stealing that from Robert Kiyosaki. But one thing I wanted to make sure people understand is, if you have a self-fulfilling prophecy in going and finding your answers out there, you will find smart people that agree with you and they disagree with you. So we're going to talk a little bit about that today. Today marks kind of the 1 year or the 12 months of, kind of COVID-19, right? If you think back 12 months ago, we were getting ready for, the NCAA tournament or the Big 12 tournament, and it got canceled. And, I think that on March 13th, President Trump declared a national emergency. And so our whole worlds have been uplifted, turned around, inside out. I know Alex and I have sure done a lot of different things in the last 12 months, but one thing has rung true, and I think it's been investor sentiment in tangible assets. So, if you want to go find folks that will talk to you about the deflationary type of, scenario, Dr. Lacey Hunt is great to talk through that. And there's plenty of other people that will advocate for the inflationary, but I'm always looking for ideas that are contrary to popular belief. And, when you think about another $1.9 trillion being printed, and you think about, the CARES Act, which was the largest stimulus in our history of 2.2 trillion. You think about all of these things, and 25 or 30%, depending on who you ask, of all currency that's in circulation right now has been printed. It's hard to think that there might be deflationary measures that could happen, but it is a potentiality and one that we're going to talk through. But anyone that tells you that you have a crystal ball and knows all the answers at this point, I think they seem more fitting for one of my kids' Disney movies than advising folks on investment behaviors. I mean, again, no matter what your stance is on the economy, inflation, and interest rates, it's typically a more prudent decision to have, I think in my opinion, to have more control in your portfolio than less control. And in commercial real estate, you have the ability to force appreciation. And so I don't know about you, Alex, I don't know about your traditional equities portfolio and your stocks, but I cannot force appreciation to my stock portfolio like I can on my real estate portfolio. So we are of the opinion that tangible assets like commercial real estate are a far better way to hedge against Wall Street and inflation than trying to take on the aforementioned 800-pound gorilla that is the Fed by producing housing, places for people to work, shop, and play. So I'm not going to get into it too much. However, I do want to talk about the importance of understanding the levers that are being pulled and the makeup of those levers that influence the direction that the economy is going. I think it's a losing game to try to time the market or game the system. The smart money is putting the money where they've always put their money. We've talked about this a lot, but it's to seek diversified cash flow, seek assets with intrinsic value, and think long-term. All three of those things that commercial real estate hit on. And so one asset that I like to, steal from, pull from, model from is CrowdStreet. I think they do a great job of, understanding the different forces at play in the economy. And they put out a lot of great resources, but I've written about this a lot. And it's this modern portfolio theory, which, if you think about all the endowment funds, you got Harvard, Yale, and all those endowment funds, the ones that have had the most success do not have a traditional 60-40 stocks and bonds kind of makeup. There's some sort of tangible asset in those. And so we link to, in our market commentary, some links about the modern portfolio, an article that CrowdStreet wrote. I won't do a shameless plug and say you should go write or go read what I have written. Go take it from CrowdStreet and their resources. But we also have some other resources on how, if inflation does rise, how it's going to boost commercial real estate's own asset classes. And when you think about that, it's like, man, can real estate continue to get pricier and pricier? And I think that it's one sentiment that you and I, go through with investors all the time. It's like, if you compare commercial real estate to what it was 5 years ago, yes, it's going to look pricey. It's going to look like prices have increased, because they have. But against what? Compared to what? Like, what's the alternative? And I think that's the question that you have to continue to ask yourself is, what is my alternative opportunity to invest in? And, if inflation does rise, how's that going to impact my portfolio as a whole? And, I think that, commercial real estate, multifamily, triple net leases was what we focus on. They all do a really good job of providing you, cash flow and a hedge against kind of interest rates rising and or inflation. So I'm not going to preach on it too much more, other than the fact that we have some great resources in the market commentary this week to check out. Think about that modern portfolio theory and how you can allocate resources to modeling the same way that Harvard has, Yale has, and those really smart folks up there in the Northeast have focused on a regular basis. And so, obviously, it's our job to keep a track on all of those different factors. But for me, or for Alex to tell you kind of what the best decision is right now from a timing standpoint is not our job, and we won't do that. What we will do is seek, tried and true investment philosophy and theories that are rooted in a lot of historical performance. And I think you can go find that in the in the commentary that we've put up here. So, Alex, with that being said, my man, I wanted to talk with you today about how you're feeling in relation to 1 year of COVID-19, how it's changed your life. And, let's look into the future and see what opportunities we've got.
Yeah, 2020 for, I would say, everybody was a different year, myself included. A lot of great things, a lot of bad things, a lot of in-betweeners. But I think the thing that we talked about a lot on this video series is that we're always looking towards the future, not trying to predict it.
Right.
But we're always looking for safe alternatives to what somebody else might be preaching about the future. And one thing is pretty clear based on what the Federal Reserve has done over the last 35 years or so, maybe even 40, is, they want a healthy inflation number. They don't want it to be too high. They don't want it to be too low.
Right.
Because it shows that the economy is growing, et cetera, et cetera. So when you take that into account, to know that inflation is something that in general is demanded from our own Federal Reserve, no matter what you think about it, that's a way that that $500,000 today is going to be worth much less in 3 to 5 years. So the properties you can buy for $500,000 today, you can't buy them for that in 3 to 5 years. And so there's all sorts of other ways to look at the forced appreciation. You can buy in great areas, you can buy and do rehab, and you can also buy in great, well-established, recession-resistant cities, such as Kansas City, which has proven both the last recession, the Great Recession in 2006, 2008, whatever it is, how it dipped like every other city, but nothing like the coast, right? We know that. And then now this one as well. So it's positioned well with low taxes and all these other things we talked about all the time. But here we are in 2021, and we've got product out there and available that's cash flowing. And then we also have everybody's got a new outlook on how the market's going to look. We're already starting to see redevelopment continue to explode in Kansas City. There was a long pause, just like everywhere else. But people are starting to take those risks again. And the other thing you got to look at is we say all these things, and then also you look at the cost of money. I mean, money is so cheap right now. You're going to be kicking yourself in 5 years. At least I am. I'm going to be kicking myself in 5 years if I'm not taking advantage of this market. Because we know that it's just going to, it can't go any lower, really. And so it's just going to go up.
Believe it or not, there is a debate out there about negative interest rates. And so if you want to go find it, you can, my man. It's crazy. And that's why we're not here with a crystal ball, right? We're just trying to give you access to the opportunities, that we see in our marketplace. And so, one thing we didn't talk about is the velocity of money. Okay, just because the government is printing money doesn't necessarily mean that inflation is going to rise. What we see with, the Federal Reserve, there's M1 and M2. M2 savings have gone through the roof. And so the velocity of money relates to the fact that money needs to be spent into the economy, right? Like it needs to, go to the hairdresser who then goes and buys her or his groceries. And then the grocery store, buys more produce. And so that's the velocity of money. We haven't seen that happen. And so until that velocity of money really starts to happen, I'm not convinced that, necessarily inflation is going to go through the roof. And so, frankly, I think interest rates, we're going to be in a low interest rate environment. And I've done a ton of studying, mostly through Ethan Pinner, who was the godfather of the CMBS loan product. And so if you want to go follow Ethan Pinner with Mosaic, go check his out. He's got a lot of resources. But at the end of the day, that money needs to be spent. And what we're seeing right now is that money's being saved. And at some point, yes, there will be revenge travel. There will be, all this money being spent, and we'll revisit this conversation. But until then, go get yours out there, go lock it in and take into consideration the opportunity that we have right here and right now. So with that being said, my man, let's talk about some new deals, because if anybody's been tracking the top 10 list, man, stuff's moving. I think we've probably got 7 or 8 transactions going right now. But let's talk about some new projects that folks might find interesting. And let's start with the duplexes out in Lease Summit, my man.
Yeah, so these duplexes are Class B duplexes, means that they're relatively new. They're in great condition, built in 2005-ish. So it's got all new building systems in it, or the newer style of building systems. It's Lease Summit, okay? And that's a Class A market. We've talked about it a lot. We've sold some product there. We've had some other product just fly off the shelves there. Of course, I'm partial to it because I live around there. But,
Sure.
This particular seller is interesting. He brings up a great point. With the cost of all the lumber and the cost of all the products, you can't build a new product anywhere close to this. And so it's a Class B product, but you really got to think about it as, okay, it's fairly new and all these other things. And then it also produces cash flow. It's 100% occupied. And he's getting pretty good rents out of them. I think there's a lot of opportunity to increase those rents. They all have a 1-car garage. So it's, again, these townhouse style duplexes where it's, you're only sharing one wall with your neighbor. So they're in high demand, great schools. Of course, everybody's going to want to live there. And it's about a 5-minute walk to downtown Lease Summit, which we've also talked about with their new $50 million development that actually I drove by the other day. And there's massive walls of concrete for parking garages and some of these other things that you'd expect, almost in downtown Kansas City. But that's available, just came to us. We've got the rent roll and some other documents in there that you should definitely check out.
Excellent. I was in Lease Summit on Friday, and, I was telling you that I came off of 470 and it came in from that side of town. And, the new development that's being delivered out there is massive. Not only on the multifamily side, you've got a new grocery store, you've got Firebirds, you've got Starbucks, you've got all of these different developments happening in Lease Summit. So I think that Lease Summit's only on the up and up. and it's a hot spot right now in relation to a submarket of Kansas City. So excited for investors to get access to that deal.
Yeah. And then also we have in another close to an A market, maybe it's an A market, I would consider stuff that we know a lot about because we sold a 32 unit project in Raymore.
Yep.
And so we have another 32 units that's similar in style, meaning it's, again, these townhouse styles. They have garages, all separately metered. So owner really doesn't have any utilities on it. The tenant pays for everything. But this one is a little bit older product, but it's also a lot lower price point. And this one's an off-market deal. The one we sold earlier this year, we sold to one of our clients, and that was more of an on-market deal. So we have information that we can provide around that property that is something that you should take a look at. Again, 32 units and, you know, very low owner expenses, and it's an opportunity to get these very solid Class B. This might be B minus because it's built maybe in the 80s, 90s, but a great neighborhood in Raymore, which also has great schools.
Yeah, Raymore is an interesting one. It's kind of a safe haven for a lot of folks, I think, because you still get access to feeling like you're in a kind of a rural area, but you also have the opportunity to get wherever you need to get to very quickly. And so that submarket's vacancy has been so low over the last 2 years, and there's been a lot of demand for properties over there. You mentioned that we sold the 32 units, yes, but I had been doing fourplexes on Skyview and different areas in Raymore for a couple of years now, and the investors that have bought those have said, "Man, I have a waiting list every single time I'm trying to, you know, I have a vacant. I got that thing, you know, turned very quickly." So I think there's a little bit of a desert when it comes to product out there as well. So I think these are two great opportunities for investors right now to go lock in some great debt on these projects and, you know, frankly, get in for prices that you can't build for. I mean, we talk about that a lot because rising construction costs, supply and demand, and it's hard to build new product that hit price points in the B and definitely not in the C market, which is most of the stuff that we work on. So, Alex, where can folks find out more information about the deals?
Best way is you got to sign up for our BRSS process, and you can reach out directly to me on LinkedIn, send me an email, alex@clemonsrealestate.com, or you can send it to Logan if he wants to answer it. But you know, the best thing is get in contact with us. We'll get you going on the process. We've got a couple new people into the works this week. And I mean, if you look take a look back 6-8 weeks ago on our deal flow email, you can see that I think almost all those are gone.
Yep.
You know, so Q1's been very hot. Q2 is, I can already tell it's going to be even hotter. So, you know, take a look, and I'm here to answer any questions.
So what are you waiting for, right? Let's get you at your next project. We're here to help through the whole process. You know, we're going to be going through a large acquisition with the client here very soon. And I told Alex today, you know, what makes us stand out from the rest? So I think it's taking that owner's mindset and opening up the whole playbook, not only from the process, but also the relationships. You know, I think that a big piece of getting into commercial real estate is you need relationships to bring you opportunities. That's what Mr. Alex Olson and myself are doing. But two, you need relationships. When a problem arises, who can you call? And you can call us, and we can call 5 to 6 people that can solve that problem for you. So make sure to sign up for the BRSS. Check out the new Lease Summit duplexes and the Raymore deal. And we're going to be bringing you more projects every single week. Weekly commentary is going to have all the resources on there that I talked about, the modern portfolio theory. And if you want more links around, you know, all of the study that I have been doing on interest rates and inflation, reach out to me. I'm happy to share them with you, but be careful because it can be a black hole. It can be a black hole. So with that being said, AO, thanks again for joining, man. Thanks for bringing great projects, and we look forward to getting you guys your next deal. See you later.